Reliance Industries delivers in the third quarter, posts its best ever quarterly profits of over 7,200 crore rupees. Gross refining margins hit a 7-year high, though coming in a tad below estimates.
Cain Energy sues the government for damages worth $1 billion. Cries foul over touching its Cain India shares in the retrospective tax case. This even as Finance Minister Arun Jaitley is in London holding talks with his British counterparts and large investors.
The International Monetary Fund cut its global growth forecast, maintains China's GDP will slow down to 6% in 2 years. India will emerge as the fastest growing nation, but GDP will remain below 8% at least for the next 2 years.
China's quarterly growth slows down to the lowest level in 25 years. GDP for the full year is also sub 7%, slightly below street expectations.
Bulls catch their breath on the Lal Street after a tumultuous start to 2016. The Sensex rallies 300 points from oversold territory. The Nifty back up above 7,400. Mid-caps also breathe easier today.
HCL Tech punches above its weight, beats all its peers in the December quarter with the fastest dollar revenue growth of 1.4%. Also garners deals worth over $1 billion for the 13th quarter in a row.
After a torrid 2015, Gartner forecasts a marginal pickup in IT spending this new year, but does not expect a full-blown recovery at least till 2019.
Supreme Court throws a spanner into the government's plans to sell its residual stake in Hindustan Zinc, says there's no need for urgency and seeks Parliament's consent.
Solar energy tariff falls to record lows even as renewable energy industry cries foul over the low rates. Finland's Fortum Energy bagged the tender to build a 70-megawatt plant by quoting just over 4 rupees a unit.
Davos is going to be overrun with business leaders, heads of state, economists, scientists, Nobel laureates, over 2,500 of them attending for the World Economic Forum's annual meeting, and there's no dearth of issues to worry about. Hey guys, this is what it feels like to be on top of the world.
I do think the next 3 to 5 years could be very unique for India if we play this well.
We are cautiously optimistic, so to speak.
Well, it's that time of the year when the world's most powerful and influential leaders gather at the Swiss Alps in Davos. The World Economic Forum kicks off and there is no dearth of talking points. The market crash, the crude collapse, the China slowdown, and now the gloomy forecast from the IMF. We will bring you all the action and all the big voices right here on CNBC TV 18. Good evening. Thanks very much for joining us on India Business Hour. Hi, Nandara.
Hi, Shireen. We've got Menika Doshi there. It's minus 11 degrees in Davos. It's very chilly, and that seems to be the mood across global markets as well, though we have seen a lot of green today.
Well, we have seen green, at least as far as the markets are concerned, and on the earnings calendar. That is our top story tonight. Reliance Industries and its spectacular Q3 performance. For the second quarter running, Reliance has reported quarterly profits of over $1 billion. The company posted its best ever profits of nearly 7,200 crore rupees, and gross refining margins are at a 7-year high, coming in at $11.5 per barrel. There are, however, some minor irritants. The record high gross refining margin was slightly below street expectations. Refining growth of 16% was also tad below expectations. And there was no concrete roadmap for the Reliance Jio rollout. But Anuj, who tracks Reliance closely, joins us now to take us through the quarter gone by. Anuj, another strong quarterly performance by the company. Break down numbers for us.
Okay, let me start with the standard disclaimer. Of course, Reliance owns both TV 18 and Network 18, the companies that own the channel that you're watching. The net profit clearly beats street estimates. The net profit came in at 7,200 crore. Expectation was 6,950 crore, and that compares to 6,560 crore quarter on quarter. So it's a significant 10% rise in the net profit number. What the street would be slightly disappointed by, going by the kind of run that the Reliance stock has had, is the gross refining number of margin of $11.5 per barrel, and the refining EBIT going up 16%. The market had factored in a 24-25% EBIT growth for refining performance. In itself, it's not bad quarter on quarter, but as I said, because the stock has rallied, maybe that's a bit of a disappointment. But then the petchem performance has come flat, where the street was expecting a 7% decline quarter on quarter, and there's an other income jump as well of about 700 crores. So it will be interesting to see how the stock reacts, because going by empirical evidence, the stock normally peaks out after delivering numbers, even if the numbers are good or ahead of estimates. These numbers are ahead of estimates, but you could say that there are reasons to believe that the market could be disappointed by a couple of metrics. So all in all, you'll have to say that good numbers, but the jury is out on what the stock does from here on.
As we look at the margin environment, even though we are seeing strong numbers, these margins still represent 5-year mid-cycle levels and give us the comfort that there is sufficient elbow room for improving margins as the cycle in both our chains gathers momentum in the coming months.
So strong earnings, they're coming in from Reliance. Look at the GDR, it's higher by over 1%. It has come off its intraday high. The markets had already shut for the day when Reliance came out with its numbers, so this will be a stock to watch out for. But on to the other big story tonight. The retro ghost is back to haunt the government. Cairn Energy has sued the centre for damages to the tune of $1 billion. The British company is seeking damages for losses it suffered in its Cairn India shareholding after the taxman slapped a 10,000 crore rupee notice using the retrospective amendment. And this comes at a time, ironically, when Finance Minister Arun Jaitley is in the United Kingdom to meet his counterpart George Osborne. Nantara, you've been tracking this story. Arbitration proceedings are now underway because a presiding officer has recently been appointed. What does this mean?
So the presiding arbitrator, the umpire for this 3-member arbitration panel, Shireen, was only nominated last week, so we haven't even seen the first hearing of this. But this is significant. Cairn Energy now becomes the first company to sue the government to seek damages as far as this controversial retrospective tax goes. It was in March 2015 that Cairn Energy actually received a draft assessment notice from the Income Tax Department for $1.6 billion plus penalty plus interest. So that is why it is seeking this $1 billion, saying that its 9.8% shareholding was locked into Cairn India. It was barred from selling that, and since it wasn't allowed to exit Cairn India, it has lost its value. It has had to sell other assets around the world. It's had to delay other exploration programs as well. It's going to be interesting to see if Vedanta is also going to seek damages from the government or not. It has said in the past it will also consider damages. The other thing that we have to watch out for is the UK-India treaty. Simon Thompson, the CEO of Cairn Energy PLC, quite convinced that Cairn Energy has a very strong case. This is a government, the new government, the NDA government. Arun Jaitley has said he's not going to, issue new tax notices. But is the investor community convinced or not?
Well, it doesn't seem like that. To talk more about this, we're now joined by senior advocate Porus Kaka. Porus, appreciate you joining us here on India Business Hour. A quick comment from you on the developments as far as Cairn Energy is concerned, now suing the government for damages worth $1 billion.
Yes, well, it's entitled to. I think there is the bilateral investment treaty, and that provides for arbitration. So Cairn is looking into its rights out there. As far as the government goes, I think Mr. Jeffrey from the beginning has put what he calls these legacy issues in one basket. And on the retrospective, he's made it very clear that the present government will introduce no fresh retrospective legislation.
But to deal with the ghost of the past, Porus, and we've been speaking with the Ishwar panel, and the Justice Ishwar panel, we're given to understand, will only look at addressing the controversial Section 9 changes in the second set of their recommendations. They've submitted their first set of recommendations, but a member of the Ishwar panel telling us that Section 9 related issues will be dealt with in the second set, which could take another 2.5 months for the recommendations to be prepared. So it's unlikely that we could see any relief on this front anytime soon.
That's absolutely correct, Shirin, and that's really the correct way to go about it. And I don't even know whether retrospective issues are within the remit, but anyway, if they look at it, nothing like it. But Section 9 has already been dealt with. I mean, we have a unique situation where going forward, the legislation has been cleaned up in the last budget. But all those caught between 2012 to 2015 have not only the retrospective amendment, but a very poorly drafted law. So I think at some stage we will have to look at that basket. But currently, I think the government has said we've either appointed a panel or we're going to leave it as a separate legacy issue to be dealt with the courts. It's not a very happy situation, but I think the government has decided that this is a legacy issue which they can't sort of just legislate on the retrospective amendment itself.
And arbitration proceedings now underway in this specific matter. But Boris, before I let you go, what does this now mean in terms of investor sentiment? I mean, you've already got a fairly gloomy global outlook. The government is talking about trying to draw in investments and big-ticket investments into India. It's ironic that the finance minister is in London today meeting his counterpart as we hear this announcement coming in from Kane Energy. What is it going to mean in terms of big-ticket investments?
Well, if you look at the big-ticket issues, I think, for example, the FII and the MAT issue was probably more big-ticket than this. The reason is Ken is an individual issue, and it is a specific legacy issue. On FII and MAT, the government not only introduced a process, they followed it up, they were quite, prompt. So I think they've done well. Now, this is an unpleasant situation. What to do with the past? The investing community would love a retrospective on a retrospective. But I think just removing the tax, the government does have its problems. In fact, if you remember, the BJP itself was a part of the parliament that passed the 2012 Act. So I think they are in a difficult position. And the investing community, I think, has to a certain accepted that, look, this will be dealt with perhaps through the courts, or through the Ishwar panel, or something else. But it's not going to be simply legislated upon and given up.
All right, Boris Kakar, as always, appreciate you joining us here on CNBC TV 18 to give us your comments on the developments of the day. That's Kane Energy seeking $1 billion in damages from the government. From Kane Energy to Kane India, the Delhi High Court has set a 2-week deadline for the government to firm up its views on allowing Kane India to export crude from its Rajasthan block. Now, the court has gone on to observe that forcing Kane India to sell crude in the domestic market at a lower price is actually hurting the government's own profit share, which exploration major Kane India argues could go up by as much as 1,400 crore rupees if it was allowed to export the crude. Ashmit, who was in court, joins us now with the details. Ashmit, we're talking big numbers here. The court has given the government 2 weeks to come up with a response.
Indeed, that's the time, and this has been termed as the last and the final opportunity for the government to come out with its final position as far as exports is concerned. Now, as you of course pointed out, Kane led with that argument, questioning whether is the government losing out foregoing royalties worth 1,400 crore rupees by disallowing Kane from exporting crude from its Rajasthan fields. That's the sum and substance of their arguments. What they're essentially arguing before the High Court is that the production sharing contract provides for a certain portion of the oil recovered to be sold to government and to PSUs. What their argument essentially is that the government has not been picking up its share, and that balance component is being forced. Kane is being forced to sell that balance component to local refiners, and this sale is being done to local refiners, to domestic refiners, at a significant discount to international prices. And that's their contention here, that even if the sale is being made to domestic refiners, why not at international prices? Towards that end, they also argued that they've written to the DGFT, they've also written to various government agencies to ensure that this export process is fastened, is hastened, but as of now, no, they have been met with dead silence. That's Kane's contention here. Now, in response to this, the Delhi High Court questioned the government. The government, as of now, has clarified that they have been seeking the opinion of the Law Ministry, and they're waiting clarity on that. But meanwhile, the prima facie view that the government has taken is that there is no room for export of crudes as per the production sharing contract. That's the government position as of now. Now, this was met with a lot of criticism. It was reprimanded by the Delhi High Court. The High Court held that prima facie it appears that the loss is causing that this sale to domestic refiners is causing a loss to the government. The High Court also reasoned that if the sale is being made to domestic refiners, why provide that arbitrage of acquiring crude at lower than international prices and then being allowed to export the refined oil at international prices? So clearly tough questions being raised here. As of now, the Delhi High Court, as we had said initially, has given a last and final opportunity to the government. In 2 weeks' time, they will have to come come out and clarify their position. So February 4th will be the big day. That's when the onus will be on the government to clarify and crystallize its position on export of crude. Back to you.
So the next hearing we'll know what the Petroleum Ministry has to say. We did have Cain India management on the channel saying it's unfair the company has to sell its crude at a 25% discount to Brent. Thanks, Rashmi, for joining us with that. 2016 may be a year of weaker growth than earlier projected. The International Monetary Fund has cut its global growth forecast for 2016 to 3.4%, but says India may still be the story of the year. CNBC TV 18's Rita Singh reports on the global growth forecast and the challenges identified so far.
The global growth engine is slowing down. That's the warning from the International Monetary Fund, which has trimmed its global growth forecast yet again. In the latest World Economic Outlook report, global growth is pegged at 3.4% in 2016, down 20 basis points from the earlier forecast. It says that the earlier projection of 3.6% for 2016 may now be achieved only in 2017.
We may be in for a bumpy ride this year, especially in the emerging and developing economies. China's slower growth and rising financial market risks amid a process of macroeconomic rebalancing, the fall in commodity prices, notably the price of oil, and asynchronous trends in monetary policy.
The risks come from the world's developed economies. Growth in these economies is projected to be slower than earlier anticipated, coming in at 2.1% in 2016 and holding steady through 2017. This is mainly attributed to slower growth in the US. But throw in the already evident slowdown in China, and growth momentum in emerging economies could well be derailed. The IMF report estimates growth in emerging markets at 4.3% in 2016 and 4.7% in 2017. Both of which are 20 basis points lower than the earlier forecast. India may not be completely immune to these turbulent times either, but the IMF says India is poised to record the fastest growth among its emerging market peers at 7.3% in 2015, 7.5% in 2016 and 2017. A lot of this caution stems from a belief that risks to global growth remain tilted to the downside and relate to ongoing adjustments in the global economy. The four biggest risks remain: a sharper than expected slowdown in China, further appreciation of the US dollar and tightening global financial conditions, a sudden bout of global risk aversion, and any escalation in ongoing geopolitical tensions. If any of these risks are mismanaged, the IMF warns emerging markets may take it on the chin and send global growth reeling. In Mumbai, Ritu Singh.
That's IMF cutting the global growth forecast. Status quo for India at this point in time. Meanwhile, China has grown at its lowest pace in 25 years. Growth for the full year number has come in at 6.9%, and that is short of the government's expectation of around 7%. So while it is a 25-year low, it is not significantly lower than what the street was factoring in or the street was working with, and which is why you saw the markets not react negatively to that number. In fact, the bulls finally got some breathing space across global equity markets and the Lal Street today. Our markets saw a relief rally after being battered and bruised since the start of the year. The Sensex gained nearly 300 points, gaining more than 1%. The Nifty moved closer to 7,400 after gaining about 80 points. Mid-caps also got some much-needed relief, with the index gaining about 170 points. So that was the story back home, and it's a similar story playing out on Wall Street for this evening, where the major indices have opened in the green, with the Dow trading more than 1% higher. Bertha joins us now live from the Nasdaq. Bertha, finally some cheer on Wall Street and across global equities.
A little bit, Shireen. It seems as though the markets had already anticipated that weaker number coming out of China, and some are starting to posit whether or not maybe Beijing may enact some sort of stimulus in response to that. Interestingly, analysts have taken down their estimates for S&P 500 earnings growth in the first quarter. They now see a decline of more than 0.5%. And the numbers we're getting today are sort of bearing that out. We did get a beat on the bottom line from Bank of America, although its top line was a little bit shy. Morgan Stanley beat on both the bottom and the top line, a lot of that due to cost cuts. Delta's profits actually miss, and Delta is looking out for the year ahead, says they expect to actually make a bid for the 49% of Aeromexico in the June quarter. They're cutting their Paris capacity and capacity to Europe overall in the wake of last year's terrorist attacks, and they do expect to see fuel savings, which you would have thought had been a tailwind. They said whatever fuel savings they have, they're going to plow into share buybacks rather than cutting prices for flyers. Tiffany's cut its guidance, talking about the strong dollar, the fact that they're seeing weaker buying worldwide. They're also going to make some staff cuts as well, and we're hearing about staff cuts at J&J. Yahoo reportedly could cut up to 25% of its staff cuts. Meantime, Star Wars apparently may be a little slower on its way to a worldwide box office records, apparently because Boonie Bears, which I have never heard of, this is a Chinese animated franchise, has beaten out the Force in Beijing. I don't know what Boonie Bears, but I guess kids really do dominate the market.
I don't know either, but I guess we learn something new every day, don't we? Appreciate you joining us here on CNBC TV 18. Bertha Coombs there reporting from the NASDAQ on the U.S. markets, which are currently trading higher. It's a quick check of the crude price as well. Brent has surged sharply. It's still near its 12-year lows, though. Both Brent and the NYMEX hovering around the $29 mark, so it's 0.5% lower for NYMEX and Brent trading about 2.5% higher. Now, the world may be headed towards a recession. That's the view coming in from the Vice Chairman of private equity giant Blackstone, John Studesky, speaking to CNBC TV 18's Menika Doshi in Davos, the day before the World Economic Forum kicks off. John, who's also a veteran of the Indian market, says there's always an opportunity to make some money in India, provided one chooses the sector or the state judiciously.
In the pure manufacturing space, you are starting to see the onset of a recession, namely manufactured goods. The amount of output in the United States or in Europe is materially lower over the last 12 months than it was of the previous 12 months. So what I call a manufacturing recession is definitely being witnessed. Now, how that translates into the consumer, I think 2016 you may not see a recession. 2017, the signs are that it could be the case. I think, remember, you also have another concern, which people don't like to discuss, which is, of course, deflation or disinflation, of namely, it's driven in part by commodity prices, all shifting downward. Housing prices in the United States, pretty sound, but you also have a broader concern that the consumer is going to start to save more, and that's going to create a lower demand for the broader consumer space.
Given this context, many in India believe that this is the year India will shine, not just in Davos, but in the global economy. Is that your expectation? You're an old India hand, and you've been watching India very closely for many, many years now. So I'm just curious to know, are we at a tipping point in India? Is this going to be our moment? Because we've asked that question several times before in the last decade.
Well, I know. The old question about emerging markets, are they still emerging or never emerged? I mean, I've been going to India for business for over 25 years. Blackstone's been investing in India and quite successfully for over 10 years. We're entering our second decade. Having said that, it's all relative. And as you and I were discussing, from an emerging market peer group, India is going to be an interesting place for capital in certain sectors. But I would say two or three things. Number one, it's going to be on a state-by-state basis. I mean, remember the Gujarat model that Mr. Modi perfected, people are now looking at that model saying what other states can have real proper use of invested capital. Secondly, real estate. We found that real estate has been a very good asset class for Blackstone. And we think certain aspects of technology services, certain aspects of retail could be very attractive.
So real estate paying dividends for Blackstone. We'll head back to Davos in just a bit and get you more big voices. That's coming up for you later on India Business Hour. On to Earnings Corner now. India's fourth largest IT player has done a strong performance in the October-December quarter. Net profits jumped a higher than expected 11% quarter-on-quarter, helped by a 1.4% jump in dollar revenues. And despite the negative impact of the Chennai floods, growth in constant currency terms came in 2.1% higher. CNBC TV 18's Rima Tendulkar and Arundhati Raman break down the numbers for you.
HCL Technology has delivered on street expectations in this challenging quarter. After lagging peers in the prior quarter, HCL Technology's growth has rebounded smartly, led by strength in America and infrastructure management services.
Operationally, the October-December quarter has held its ground. EBIT margins came in at 20%. Now this is a tad lower than the projected 21 to 22% range, but the company says it has no complaints and expects to do better in coming quarters.
We continue to have that as a targeted margin range, which is 21 to 22%. If you see this quarter, there has been a significant improvement in margins. If you look at our EBITDA margins now are at 21.5%. Which is an increase of about 90 basis points as compared to last quarter. If you look at an EBIT level, the margin again has increased.
For the strong overall performance, India's fourth largest IT player can thank multiple factors. 1. The American market has seen a strong 5.5% growth. 2. Its infrastructure management services business has rebounded smartly after 2 weak quarters, clocking 3.4% growth quarter on quarter. And 3. Order book inflows have been robust, with the company bagging deals worth over $1 billion for the 13th quarter in a row.
Our order book continues to be very robust.
Better than what it ended in?
We signed another $1 billion worth of large deals, 8 transformational deals in there. Again, well spread across multiple business lines. We have not obviously included the large Volvo engagement yet in any of these numbers. They're not signed. It's still an LOI. The contracting is going well. It's going as per plan. So we continue to be very hopeful of it getting done on time as per plan. So I would say otherwise the order book is very healthy. On a constant currency basis, we delivered CY15 grew by 13.5% over CY14.
In addition, HCL Tech's retail and finance verticals have registered above average growth rates. This has offset the negative impact of slower growth in a few verticals like engineering, which contracted 1.5%. Some of the other headwinds HCL Tech has had to overcome include a 2.4% contraction in Europe and a 3.4% contraction in the rest of the world. But the management is positive growth will accelerate in the second half of its financial year, which ends in June 2016.
H2 will be better as compared to what we've delivered in H1. The deals which we have signed, they continue to move into steady state, so we're extremely confident of their conversion and then realization over there. If you look at our deal pipeline, again that continues to be robust.
The impact of seasonality was exaggerated by the Chennai floods for the Indian IT industry in the December quarter. In these challenging times, HCL Technology has managed to outpace peers with a dollar revenue growth of 1.4% versus a contraction for TCS of 0.25% and just a 0.6% growth for Infosys. Even in constant currency terms, HCL Technology leads with an over 2% growth. However, in terms of margins, TCS continues to remain the sector leader with margins of 26.5%.
Well, that's HCL Tech for you delivering this quarter. Now, 2015 saw the largest dollar drop in IT spending. That's the word in from Gartner, which expects a full-blown recovery in IT spends only by 2019. For 2016, however, a marginal 0.6% recovery in global IT spends is likely. The picture is better for IT services spending. Kritika joins us now to explain that. Kritika, what really were the villains that hit spending in 2015, and does 2016 give some hope for a pickup in demand for Indian IT services?
Well, let me talk about 2016 first. So there is some ray of hope in sight in terms of IT spending. The overall growth is expected to be at 0.6%. So the overall IT spending will stand about $3.54 billion. But if you look at the IT services spending, as you said, that is slightly higher, which will impact Indian IT services firm at 3.1%. That's versus a decline of 4.5% last year. The reasons for this are simple. Acceleration in cloud adoption has been significant in the last couple of months, and hence buyer acceptance of the cloud model. That is, US companies and Europe companies are accepting the cloud model now. Now, in terms of 2015, what's interesting is that Gartner has pointed out that IT spending was the worst ever since Gartner has started studying IT spends. So for 2015, the spend was $216 billion, lesser than 2015, the sharpest fall ever. And the 2014 levels may not be met. That is, the 2014 IT spending levels will not come back till 2019. Now, you asked me about the basic villain. It's all about currency, really, because that seems to be the reason why individual companies have significantly slashed down their discretionary spending. However, those headwinds may marginally get better. So yes, the picture is slightly better if you see comparison to 2015 for 2016, but we'll only know by the second half of the year if it's actually trickling into the Indian IT services companies.
All right, Kritika, appreciate you joining us. So expect the outlook to be better in 2016 when it comes to IT spending. Now, he's a college dropout who's literally driving the world right now. The founder and CEO of one of the world's most successful startups, Uber, is in India. And while he was one of the key speakers at the Government Startup India event on Saturday, today was his turn to meet some of the brightest minds in India who could very well be on their way to set up their own startups. Travis Kalanick shared some of his experiences with IIT Bombay students, and while he did highlight the need to work hard to make one's dream work, he also had some interesting advice for the future startup entrepreneurs. It's crucial to be good at storytelling when one goes out to search of funds. Priya, who was present at the event, joins us now from the IIT campus. Priya, it must have been a masterclass for students there.
Well, the session not only saw students but also entrepreneurs and aspiring entrepreneurs attend in large numbers. Now, Uber chief Travis Kalanick actually made it clear that India holds a huge opportunity and the startup space in the country has been thriving. In fact, a case in point being Uber, which had a market share of about 4% in January last year. This has exponentially grown to 40% over the last 1 year. In fact, 50% is the kind of market share that Uber holds in several top cities as far as the Indian market is concerned. But of course, Uber had made a decision to invest about $1 billion into the country to ramp up its operations last year, and that's primarily because of the growing competition from rivals like Ola, who have been using discounting as a major part of their strategy. However, Travis Kalanick actually says that the idea is to spend every dollar more efficiently than competition. So we'll have to wait and watch how Uber's growth story pans out as far as the Indian market is concerned.
We're going to leave you with a tribute to Glenn Frey, the founding member of Eagle, who died in New York on Monday at the age of 67. I don't know what's going on since the year of
It's a bad year, Nentar. It's a bad start so far. But that's Glenn Frey of the Eagles. And here's wishing him goodbye.